Hey everybody, good to be here today with you. Time for managing your options portfolio. So each week in this class, we go through a variety of options positions and talk about management. We're going to do that this week, of course. And also I want to talk a little bit about a slightly different topic as well, and that is legging into covered calls, because that can be part of managing a portfolio using options there. So we're going to do that. Good to see some familiar names in the chat. Glad you're here. I'm also glad to be joined by Mr. Scott Thompson in the chat. Appreciate Scott as always. And remember, you can follow us on X at Brent Moore CS, at Scott Thompson CS. For further information throughout the week, we do post most days, sometimes not on the weekends as much, on X with additional content there. So check that out. And just glad to have you with us. Options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Rolling strategies can entail additional transaction costs. And the material today is intended for educational and informational purposes only. The paper money software application is for educational purposes only as well, and it will not assign short option positions early. That's different than a real trading account. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risks, including potential loss of principal. Past performance is no guarantee of future results. Okay, so there we go. Hey, let's head on over to the Thinkorswim platform. There we go. This is the S&P 500. We've climbed. We opened up a little bit lower today. Climbing up, though. Climbing up. Actually, I guess we didn't open up a little bit lower today. We opened up a little closer to neutral today, I think. But since then, it's more of the same. There's the trend, everybody. So before we get to managing these various options positions, which I want to get to shortly, but I want to talk to you a little bit about covered calls as a management tool within your portfolio. We generally will break up covered calls into kind of two general classifications. This week, we're going to talk about legging into covered calls. Legging into covered calls simply means that you already own the stock. Now, I have some stock positions in this sample portfolio, and we're going to look at them and decide, is it appropriate to leg into a covered call on those? The other type of category that we're not going to focus on today is what we call a buy-right covered call. That is, you're going to buy the stock and sell the call at the same time. So that's not what we're doing today. Now, you may think, well, that's just kind of this artificial distinction because you end up with the same thing either way. But it really does affect things, because when you're discussing the timing, and we're going to be talking about timing today, when you're discussing the timing of when to enter these trades, there is a big difference between a buy right and legging in. So let's do this. Let's take a look at our current portfolio. I'm going to go to just long stock positions, and let's just consider some of these long stock positions and potentially, should we leg into that covered call or not? And the first one is I have a long stock position on Delta Airlines. Do you see a problem with legging into a covered call on this? By the way, they have earnings coming up this week, but that's not what I'm talking about, if that's on your mind there. Why not? The answer is, well, there's a problem here on this. We have 50 shares. For a covered call, you need at least 100 shares. So I'm going to exclude Delta Airlines to get to do a trade. So yeah, Josh said we need 50 more shares. If we add that, then we're open to doing a covered call. In general, when I'm talking to investors, people often have this 100 share mentality. You don't have to buy 100 shares of stock. Back in the day, back when I started trading, they would penalize you if you didn't buy round lots. If you bought 99 shares instead of 100 shares, the commission would be significantly higher. That, fortunately, those days are in the past. We don't have to deal with that anymore. And so if you find a very expensive stock, and you don't want to buy 100 shares, no problem. But if you are going to do covered calls, we do need that 100 shares. Let's look at AVGO here for a sec and talk about the timing of legging into a covered call. When you're legging into a covered call, you are long-term bullish, you're shorter-term bearish. Long-term bullish, shorter-term bearish. Okay, why is that? Well, first of all, if you're going to hold the stock, remember a covered call is you're holding the stock and the option, and the short option. If you're going to hold the stock, you don't want to be long-term bearish on it. It wouldn't make any sense to continue to hold that stock. Okay, so that's why you need to be long-term bullish. Short-term bearish, well, if you sell a call and the stock drops, or if short-term neutral, if you sell a call and the stock goes sideways, time decay or the drop of the stock will lower the price of the call, which is what we want because we're selling up front, buying back hopefully at a lower price after the fact. It works out there. So in other words, if you're expecting a stock to bounce up, let's say we're here and we think, oh, that stock is going to bounce up, then it wouldn't be the time to do a covered call. If you're up at a higher point and you think the stock is going to retrace, and of course this is hindsight I'm using here on this example, then you wouldn't want, then that would probably be an ideal time. But in this case, if I'm looking at what the stock has done, it has trended up well. Now that's no guarantee, but if the assumption is that the stock is going to continue to trend up, I'm going to draw a real rough line here just because I'm freehanding it here. If the idea is that stock is going to continue to trend up, then I'm going to be longer term bullish. But here's the thing, we already had the drop. Probably not an ideal time, given what I just said, to leg into a covered call on Broadcom, AVGO here, okay? So let's look at another example. So let me go back. Let's look at, I have 100 shares on CNP. Let's look at CNP. Is now an appropriate time on CNP? Well, let me pull up CNP. Here we go. Stock has run up. So very often if we expect it to drop down, but there may be other considerations as well. And what I mean by that is, in addition to the trend, you may look at things like such as price patterns. Here was a resistance level, we bounced off it. Here was a resistance level, we bounced off it. Here was a resistance level, we kind of intraday went through it, but then we bounced off it. And now we're potentially breaking through it. Now let's look at a support level. Let's look at the trend. This is what the trend is. Do you guys recognize that as a price pattern right there? That is an ascending triangle. Oops, let me get rid of my little drawing tool there. That's an ascending triangle. And often, if you get that bullish breakout there, a lot of traders will consider that to be, look for a bullish move. So even though we've extended a little ways above my moving average, maybe not. You can go either way on that, kind of competing narratives on that. But maybe it isn't the time to sell a covered call on that. But, you know, that's what you could do. And Kevin said, looks like a cup and handle too. Yeah, you could do this, okay, right? And you go, like that or something like that. Or you can do the shorter term, like that as a cup and handle. So maybe not the ideal time. Remember, long-term bullish, which I think you could make a pretty good case for that on this. Shorter term bearish, case is a little bit more iffy on that one as well there. So let's move on here, because there's one I was looking at earlier that I thought maybe makes more sense. WRB. Let's take a look at WRB. Here we go. Long-term bullish? Yeah, likely longer-term bullish. Do we seem a little bit extended on this right now? Maybe. I think you could make a pretty good case that it does seem kind of extended. We ran up, kind of flagged maybe a little bit, ran up, a little bit maybe of a, you know, the candle's not the most bullish candle today. Does it look like this may go sideways, may flag, maybe go down a little bit? Looks like a reasonable opportunity here. Okay, so that's what I want to do. Let's look at potentially adding in a short call on this trade. Now, remember, when we look at this, we have a choice of what strike price to pick. Okay, we have a choice of what strike price to pick. Now, if I choose to sell, say, an 80 strike or something like that, then if the stock goes up, and I can be assigned early, but we'll just say at expiration for our purposes, then I'm agreeing to sell it at 80. If this stock goes up to 85 or something, I may be kicking myself a little bit, but don't forget, you're still making money in that case. The stock is around 78 bucks right now. If I sell an $80 call, I'm agreeing to sell it for $80. That's a $2 gain over where I am right now, times 100 shares, so $200, plus you bring in the premium, and I get to keep that premium. And I'm not factoring in commissions or fees here, but that's not a terrible thing. Let's say the stock goes sideways, okay? Then am I going to get called out? Probably not. There's a possibility, a slim possibility, but if the stock were to stay somewhere in the area it is, I'm probably not going to get called out, and I get to keep the premium, whatever it is that I sell. If the stock goes down, same story. I'm bullish longer term. I was going to hold this stock anyway for this purpose. And what does it do? I'm not going to, unlikely I'm going to get called out, and I get to keep the premium. It's going to help to maybe offset a little bit of the pain of the stock dropping. Now, do you have any questions here? Let me just check the chat here for questions, and then we'll actually look at the actual contracts here on this. Okay. Looks like Scott is helping out on those items. Thank you very much, Scott. And okay. Josh said, am I considering implied volatility for this? I haven't at this point. In general, it's going to help out if I can sell at a higher implied volatility, and if the stock, if the implied volatility were to go down. But the reality is, if I'm selling and the stock goes down, the implied volatility is probably, if anything, going to go up. We have a little bit of an unusual, not super unusual, but we have another circumstance in there, another factor, which is we have earnings. And so I suspect if we look at implied volatilities here, yeah, they're creeping up a little bit. It means we get to sell the call for a little bit more of a premium. That after earnings, we'd expect that to drop. But you know what? It's not all this unmitigated good news that implied volatility is up and it likely will drop after earnings, because number one, we may not even hold it till past earnings. But number two, earnings means there's more potential volatility on that. But I would expect that premiums would be a little bit higher here. So I'm glad you brought that up, Josh, but here's what I would say. Look at the trade in its own right. Does it make more sense? Does the graph make sense to do that call? So let's see what we got here. Now, we've got 9 days or 44 days. Let's go 9 days, okay? And so 9 days may be cutting it a little short, okay? It's cutting 9 days of time. Maybe I'd want, I don't know, I'm torn on that. But let's see what we got. We got some weird strikes. When you see weird strikes, what do I mean by weird strikes? $39.50 strike. There's no $40 strike. Usually it's like the result of a split or something like that. So when you look at the graph, you can look and go, you can look for a symbol, a split symbol. Well, I don't see a split symbol. But if you go back farther, let's see what we got. Do you see? Yeah, they're right there. There's the split, okay? So there was a 3-2 split back in July of last year, okay? So it doesn't affect the stock now, other than we get some wacky strike prices. That's okay. That's okay. It still works. In terms of where I want to sell it, well, where do I think the stock's not? I don't think the stock, if the stock, let me go out of this 3-year chart. Let me go back here. If this continues to go up, I'm probably okay something in the $79, $80 range on this. Let's see what kind of premium we get for 9 days. I said 79. I meant, what the heck? Oh, yeah. Okay. 79 and a half, 82. Well, let's see what our premium is. 30-cent premium on a $78 stock. That's not much premium. In my mind, that's probably not worth it. Just as a rule of thumb, and this isn't a recommendation necessarily, but if you're not somewhere in the ballpark, at least, of a 1% premium, so that would mean about a 77, 78 cent premium, then if we're not, we may go a little lower than that, but this is half of that, okay? Maybe not ideal. Let's go out a little further in time, 44 days till expiration. Let's go back. We do have an $80 strike on this one. And we don't have to hold it, although we're not necessarily going to hold it for 44 days. In fact, generally on these trades, we're not going to hold it for 44 days. If I go here, spreads are kind of wide, I got to admit here on this one. A little tighter on the 77.50, but my premiums are much better on this, okay? My premiums are much better on this. So I'm not sold on the premiums here on the bid-ask spread on this. Let me just look at our open interest. Do we have any open interest? We got 121 open interest. Okay, I'm just going to be doing one contract. I'm going to see if I can fill this at kind of a mid price on this. But that's giving me, look, about 160 roughly would be a 2% premium on that. And keep in mind, I'd be selling the stock. I'm agreeing to selling the stock for $80 on this. That may make sense. So I'm going to click on this. Just click on the bid price. I don't need to do anything like covered call or select covered call because I already own the stock. I'm just selling this in addition to that. So there we go. And I'm going to just kind of move this up from my natural price, see if I can get a little bit more money out of that. And I'm going to confirm and send that. Just make sure you read this. Don't get freaked out by the max loss thing. This is just looking at this as a standalone trade, but we own 100 shares of the stock. So we are protected on that. And I'm going to send that order. And there we go. We have that. Now, when this shows up here, it's coming up. It's not going to show here. It's going to go to my unallocated. But if I want to move that, I can just move to group and move this to my appropriate group there. And now it's all going to link up right there. Okay? All right. So let me just kind of summarize this part. Then I want to get to some individual trade management here of different types of trades. When you leg in, ideally, you're finding a stock that may seem a little bit overextended. You're still bullish. It's still in your portfolio. But you think, maybe it's due for a little bit of a pullback. We're going to bring in a premium. It's going to help, we get to keep that premium, but we are agreeing to sell so we can limit our upside on that. So we got a nice kind of healthy premium on that, but we do have earnings coming up on this, which is probably one reason we're getting a pretty good premium on that. But that's when you would do this. Now, when would I buy? When would I exit this trade? Okay, I sold the call. When would I exit it? Number one, if the stock drops or enough time passes that premium, if we've made, say, 80% of what we can make on that, well, what's 80% of what I can make on that? Well, we can look. We sold it for $1.90. So 80% would be roughly, if this is worth about 40 cents, okay? 38 cents technically. Okay, I could go 0.2 times this and come up with 38 cents. If this mark price becomes like 38 cents, then we may just say, hey, great, we've captured some profit on that. That's wonderful. What if the stock goes up? Well, you can just get called out on that, okay? You can just get called out. It's not the end of the world. You've made money on it. And one of the things is when you go in, you're kind of agreeing to that. I'm agreeing to sell it for 80. Boy, 80 doesn't sound bad, especially if you held it for a little while. But if you really want to, you can look to buy it back. There's a good chance you'll be able to buy it back, but we don't know what price we're going to buy it back for. It would be, if the stock goes up, presumably that price to buy it back will be a lot more than what we sold it for in the first place. So you can do it that way, okay? Hopefully that's making sense, everybody. Now, yeah, let's see. If you have any questions, feel free to type those questions in. Otherwise, I want to look at some other types of trades here. But I think this is kind of fits well with what we're doing here, because this is using options in terms of an overall portfolio management system there. All right? Okay. Let's go over here and I'm just going to start at the top. I'm not going to hit every trade. I'll try and get a representative example of different types of trades just because we're going to run out of time, I think. But if we have time, we'll go through everything. I'm going to go to my short verticals, iron condors, short puts. Remember, when you're managing trades, and I know you guys are sick of me saying this, you need to have an exit in mind if things are going well, if things are going poorly, supposed to be an R there, and if things are kind of going so-so. And usually if things are going so-so, we're holding on to it. Often that means some sort of a time exit. And often in this webcast, what we use for our time exit is less than 10 days to go to expiration, or about a week or something like that, okay? So when we see an option that's getting closer to expiration, here's Delta, 9 days to go to expiration, we may look to just exit that trade regardless of how it's doing. Well, how's Delta doing? Well, Delta is not doing great. We're down $7 on this, not including commissions on this. So not terrible, not good, but regardless, we're probably going to look to exit out of this trade. Now, I have some sort of exit orders in place anyway, but with our time exit, I'm just going to look to get out of this. When I'm exiting a trade, I don't want to leave these orders in. So I'm going to click on it. I'm going to right click on it, and I'm just going to cancel those orders. Okay. And then what I'm going to do is I'm just going to look to exit this position. I'm going to highlight both of those. I'm going to create that closing order, and we'll put this just to make sure, try and ensure we get filled, and make sure you read it. Make sure this is doing what you want it to do before you send in that trade there. I went a little quick there. Let me just show you again. I have let me go a little slower because I realized I went really fast on that. I highlighted the contracts. You can hold down your shift key to highlight both of those. You can then right click on it and create a closing order. Okay. And then this is what comes up. Then you can adjust it. Now, if I put it at the mid price, it's iffy whether I'm going to get filled here. If I move it up a little bit from that mid price, I'm increasing the chances of it getting filled. So I'm going to confirm and send. Again, make sure you read that. And I'm going to send that order. We're out of that Delta trade just because time to get out. Okay. So that's Delta. Let's look at some others. Let's go to Apple. What's Apple? Apple is just a short put. I put this in the other day. I taught a class, a webcast for Cam on Monday, I think it was, on Monday, called Covered Calls and Short Puts. We put in a few short puts there. And one of the things we emphasized with short puts is if you enter the short put with the idea of, hey, I'm willing to buy the stock, I'm bullish on the stock, it makes the management a lot easier. Because then if it goes in the money, if the stock goes down below my strike price, right now it's at 258, strike price is 250, I can just say, I'm willing to buy the stock. Now, we are doing fairly well on this so far. Well, that means probably that Apple's gone up a little bit. Do we ever get out if it's going up? Yeah. It's going to say that same kind of rule that I mentioned before on the covered call. We're going to do the same thing on the short put. If things are going well and we've made 80%, I'm going to look to get out. Now, you can look at your PL. You can add a PL percentage column on there if you want. That's not on the default, I don't think, but you can just go to the gear over here and add PL percentage. And that is a quick view. And if you want to think about it another way, take your trade price, multiply it by 2. That's going to be about what? 56 cents. If mark price hits 56 cents, that would be about 80%. I can look to get out at that point. In this case, things are going well, but they're not going so well that we hit 80%. So what are we going to do? We're going to sit tight. We have a nice positive theta, time decay helping us out. We got 16 days. Let's move on to the next one there. Okay, let's go to Bank of America. Another short put, different expiration. Only 9 days to go till expiration. Short puts, if it's something where I'm willing to buy the stock, and we did this intentionally as a very aggressive type trade. We did it basically at the money. Okay, stock right now is basically what my strike price is, but we said, hey, I'm willing to buy this stock because I was bringing in a pretty good premium. I was bringing in $123 on this to buy the stock, and that was the goal. So no, even though I'm under 9 days to go to expiration, in this case, I'm not going to get out. I'm going to stick with it. Now, hopefully, just because I want to buy the stock doesn't mean that I want the stock to go way down. If the stock goes up or sideways, or if we don't get assigned, that's great. I'm happy to take that premium and just go on, and we could look to possibly do it again in the future. But so for that purpose, I'm going to just sit tight on Bank of America. Okay, let's do one more in this kind of short put vertical category, and that's Cisco. Okay, I've got Cisco. 9 days to go to expiration. So I'm probably going to get out of this, but let's just look at it a little more closely. When you're doing iron condors, I'm going to break it up and manage the two sides separately. I've got a short put vertical right here. I've got a short call vertical right here. Short put vertical is doing pretty well. Short call vertical, not so much, not doing well at all. So regardless of whether we're doing well or not, we're going to exit these, because whether it's going well or not, we're again under the 10-day threshold here. And in our class, in this webcast, that's one of the rules we're using. You don't have to use that rule, but very typically, traders will get out with some time to go before expiration. It doesn't have to be under 10 days, doesn't have to be a week, but usually a few days. Couple reasons for that. Well, really one reason. Well, couple reasons for that. One, as you get closer to expiration, the odds of early assignment increase. Okay, that's one reason. Another reason is, as you get closer to expiration, the gamma risk increases. In other words, to put that in maybe English, in other words, the trade can go from good to bad much more quickly than it does if you have more time till expiration. If the trade goes against me with 10 days to go to expiration, it goes against me, but usually it doesn't like go against me at at the drop of a hat. As you get within a couple days of expiration, that is certainly possible. So having said that, we're just going to get out of this. Now, one thing I would probably suggest you consider is don't get out of the whole iron condor at once. You can, if you want, highlight it all and get out of the whole thing at once. Your fill it's going to be harder to fill 4 legs of a contract at once and get a reasonable price than 2 legs at once. Now, you could even go one leg at a time, but I'm going to do it one vertical and then the other vertical. I don't have any stop or anything on this I need to cancel. So I'm just going to create that closing order. I'm going to buy back that vertical. I'm going to see if we can get a little better price on that. Firm and send, and we're going to send that. So we're out of half of that. Now what we're going to do is we're going to go and do the same thing for the other vertical, the 2 verticals that made that iron condor. And again, same thing. We're going to look to get out, and we're out. Okay? So that's our management of Cisco. Unfortunately, we lost a little money on that Cisco trade, but you know what? That happens. If you're going to trade options, there's going to be trades that definitely go south on you. Okay, let's keep on moving forward and looking at some other trades here. Let's go to long single options. Okay, Caterpillar doing quite well. It's a leaps. It's a leaps call. Okay, it's a leaps call. And you know, the interesting thing, this one was really a home run because we actually rolled this before. We rolled it when we hit, I think, above an 85 delta or something like that, which is kind of how we do these. If the delta gets above 85, and we don't really have any that are there right now. We don't have any that are there right now, but we rolled this. In fact, let's look back at Caterpillar. Here's Caterpillar. Let me get more days on here. That's not, no, that's, oh yeah. We, what did we do on this? We sold this. Why am I not showing my most recent trade? We entry. That makes sense to me. One quick sec. 450 call. And 450 call. We sold the, okay, this isn't showing the initial leap that we did, leaps we did a long time ago, but this was our roll. We rolled this out for an $8,300 credit. Things were going so well on that. An $8,300 credit at that point. And then when you roll, the PL open zeroes out, and hey, sure enough, that's continued up. Now, in hindsight, would we have been better off if we didn't roll and we just kept that higher delta? Probably, because if we did, the PL open would likely be more. We lowered the delta, which made it a little bit more of a conservative trade, but the trend is still going up. So as long as Caterpillar is still looking bullish, I've got plenty of time, obviously, on this. It's a leaps. We had, I don't know how many days we had on that, but we have a lot of time on this. And I don't see any reason, if our forecast is bearish longer term, then look to get out, but it's not, I don't think. I mean, our trend is continuing to go up. So let's skip that one. Let's keep on going. Okay. Alphabet. Alphabet, 44 days to go till expiration. Things are going pretty well. When would I get out? I get out. Even if I'm making money, I get out if Alphabet doesn't look bullish anymore. Does it look bullish? Maybe a few chinks in the armor here. It's not super bullish. I mean, we do have a lower high. That would, that could be a little bit of a concern. I do have a stop in here, and I don't see any hard reason to necessarily I don't think this is a complete technical breakdown. If this breaks down technically, significantly, even if we're profitable, we'll look to get out. Even if we have a bunch of time, we'll look to get out. But I don't see that at this point, and we have a stop loss on this. Notice on my long options, long puts, long calls, I have stop orders on all of them. That's kind of typical how we're going to do it in this webcast. Short options, not always. The short puts, we're willing to buy the stock perhaps. I'm not putting the stop loss on. Vertical spreads, there kind of limits the loss more by nature of the vertical, and slower moving trades as well. So sometimes we don't use stops on those. These we do have stops on here. Okay. Now you're going, hey, well, these are all doing pretty well. Well, that doesn't mean everything's done well. We got stopped out of one, at least I know, over the past couple weeks. I was actually out of the office last week. Thanks to Connie for filling in for me here on this webcast. So we didn't manage it at all, but if I go here and let me get rid of my symbol and we look back for long single options that we closed and here, we closed USB, okay? We closed USB. We closed Pfizer. These are both single options here that we closed. And so USB, for example, let's do USB. We got stopped out, I think, if I remember correctly. We bought it originally for $230. We sold it $230 per contract, 2 contracts. Sold it for $106 per contract. So we took, you take some lumps along the way, and we got stopped out of that one. All right. So that happens. Let me go out of here and go back. We had that Pfizer trade. I'm not going to look at that right now because I think that one we took a profit on, but I want to move on to a variety of other types of trades. Let's look at Uber here. What do we have on Uber? What's that? Kind of a weird trade, isn't it? Differing number of calls and different number of long calls and short calls. This is a back ratio spread, okay? How are we going to do a back ratio spread? And what is this doing? I think probably for most of you, when you look at this, you're going, I don't even know where this trade is. Where do I want this trade to go? Do I want it to be bullish or bearish? Where do I want the stock to go on this? Well, that's why the Analyze tab is your best friend, folks. You go to the Analyze tab, you put in your symbol, go down and make sure you don't have any other simulated trades or anything in here. I don't think I do. No, I don't. And now I can view what this trade looks like. 98.97, that's the current price of Uber. What do I want the stock to do? It's bullish. I want the stock to go up. So you get a sense of theta on this. Well, yeah, I mean, the bigger the separation between the purple line, the blue line, the more the theta is. It's not probably a massive factor here right now on this, okay? So I'm bullish on this, but at this point, regardless if I'm bullish or not on Uber, and I'd say in general the trend is going up, I'd probably consider that more bullish. You know what I'd say? 9 days. We're under 10 days to go to expiration. So I'm going to just exit this trade right now. So again, I'm going to do what I did before. I'm going to click on my sell orders that weren't triggered. Our stops weren't hit. We're going to cancel that, and we're just going to get out of this trade. And I can get out of it once, or I can get out of one thing at a time. I'm just going to create this closing order. I'm going to I'm going to buy back this call. Okay. And then we should be left with a long call. And I'm going to create a closing order on this guy too. And we're just going to move and exit this call as well, my long calls. And it's thinking, hasn't filled yet. We'll give it a sec. If you're waiting for it, normally I'd probably just wait a little bit longer on this. But if you're waiting and you're going like, I want to get this filled, just right click on it, cancel and replace that order, and you can tweak the price a little bit here. And let me just do that. That should fill. There we go. We're out of Uber. Okay. So there we go. Now, Chris said in the chat, thank you, Chris. You know what's great about you guys in the chat? I appreciate all of you for joining me today. But let me mention this. Sometimes I forget to say things I should say. For example, I didn't mention the possibility of rolling this. Yes, we could look to roll it out in time. Okay. I could say, well, look, I'm going to roll this out 30 days or something like that. I can do that. So Chris said at 9 days, look, we can exit, which was what we did, or we could also roll. That certainly would have been a very viable alternative to this. Now, I'm running out of time, but let me just hit a couple more, perhaps. Very briefly, we have Comcast. Okay, this is a skewed butterfly. Regardless, I only have 2 days to go to expiration. I'm gonna exit this trade. Okay, I'm just gonna exit this trade. I'm not gonna take the time right now to do that. I'm gonna do it right after webcast because I want to look at a couple more, and I don't have time if I exit that. Okay, so 9 days to go to expiration. Schlumberger, skewed butterfly, under 10 days. I could look to roll, I could look to exit. It's going fairly well right now. Maybe I'll look at this in a little more detail next week. I'm kind of violating the rule a little bit. We'll still have 2 days to go to expiration, but I probably want to look at it in a little more depth. But there is one more trade I want to look at today. One more trade I want to look at today, and that is Nike. Okay, last trade. What is this? This is what we've termed the poor man's covered call. We're getting beat up kind of on this a little bit because Nike, frankly, hasn't been very bullish. The long call, the leaps, has been suffering. Now, we have sold this before on Nike. Let me pull up Nike. Okay. We originally entered a trade, the 50-81 diagonal spread. Okay. We then rolled it once, the short call once. Let me get out of that so you can see. For $82 credit. Okay. We then rolled it again for $156 credit. Nice, but does that make up for the amount we're losing on the long call? No. And I'm going to roll this again. I'm going to roll it out about a month. And so let's just take a quick look at Nike. Okay. And then we're going to end up with this. I'm going to roll it out about a month. Go to November 7th. What am I going to roll it to? I'd like to keep it out of the money. I don't want this to go in the money. So what I may do is I may use Delta as a guide. Delta tells me how much the option is going to move in relationship to a $1 move in the stock price, but it also gives me a percentage guide. I can go 29%, roughly 20% or something like that. I can also look at the premium. Stocks at 69, remember what I said earlier? Look for somewhere maybe in the ballpark of that 1% premium. If I go to, say, the 74 strike, about 24%, I'm getting over a 1% premium for that roll there. So I'm going to go and roll to that 74 strike. Rolling is just going to close out the existing position, and we're going to enter the new position. I'm going to close out this short put by buying it back. I'm going to sell a new short put here. So I'm going to right click on it. I'm going to create a rolling order. I'm going to go up here. We said it was going to be November 7th, and we said it was going to be a $74 strike. Boom. It's giving us another $85 credit on that. Okay? So I'm going to put this order in and confirm and send that order. There we go. Everybody, thanks for joining me today. We talked about legging in to covered calls, when to do it, when not to do it, pros and cons. We talked about various types of trade management. Thank you, Scott, for helping me out in the chat today. As always, he's awesome. Thank to each of you for taking some time out of your day to join me. And everybody, have a wonderful rest of the day. Coming up next, we got trading price patterns. We'll see you same time next week, everybody. Bye-bye.